Okay, let's talk about the accounting equation. So in chapter one, um, we see property and financial interest. Let's assume this to be the same as assets equals liabilities plus owner's equity, as we see later in chapter two. So what is the accounting equation? Accounting equation is assets equals liabilities plus owner's equity. So every time we think of a transaction and analyze a transaction, that's always going to be the case. That's going to be a backbone to thinking about the effects of the transaction. And we'll see later in a subsequent chapter when we deal with debits and credits that will also help us analyze debits and credits. But for now, think of, you'll see in the textbook, property equals financial interest. Think assets equals liabilities plus owner's equity. So let's think of some transactions. Wells Consulting Services issues cash of $5,000. I'm sorry, they issue a $5,000 check to purchase a computer and equipment. So basically, the firm is purchasing new property for $5,000. That new property we'll call equipment. So the firm is paying out $5,000 in cash. So think about it from the accounting equation. That's affecting the left side, it's assets. So we're giving up assets to get assets. Another transaction, let's think of purchasing equipment on credit. So we'll have something called accounts payable now. So Wells Consulting Services purchases office equipment on account, that means accounts payable, from Office Plus for $6,000. So when we analyze the firm, we're purchasing new equipment, new property, and assets coming in that cost $6,000. We're creating a liability. So assets is the left side of the equation, liability is the right side of the equation. So that equation is going to be in balance. So we're going to have 6,000, not a negative 6,000, we're going to have 6,000 of liability and 6,000 of asset. And think about it, that equation is still in balance. Wells Consulting Services issued a check for $1,500 to Office Deluxe to purchase office supplies. So let's think about the actual transaction we're talking about. The firm purchased office supplies that cost $1,500. The firm is paying $1,500 in cash. So we are increasing an asset with the office supplies and decreasing an asset with paying the cash. So what happens when we pay off a creditor? Wells Consulting Services issued a check for $2,500 to Office Plus. So the firm is paying cash and they're reducing a liability, which is a claim on that asset. So think in your head, assets equals liabilities plus owner's equity. We're reducing cash, but we're also reducing a liability. So the accounting equation is still going to be in balance. And those two, that transaction, the asset is the same amount, $2,500, and the reduction of the liability is $2,500. So as we'll see, each transaction we can analyze like this. Let's talk about one with utilities. So Wells Consulting Services issued a check for $8,000 to pay for rent for the months of December and January. So how do we analyze this? The firm prepaid rent for the next 2 months in the amount of $8,000. The firm decreased its cash balance by $8,000. The equation still remains in balance. So think assets equals liabilities plus owner's equity. So if we prepaid rent is an asset. So on the left side, under the A in that accounting equation, we're increasing an asset with prepaid rent. We're also decreasing an asset with paying cash. So we are still in balance. So section 2 goes more into that with the accounting equation. Again, the accounting equation is always assets equals liabilities plus owner's equity. So here's just a short video on that, or a short audio series on that. Please let me know if you have any